Thanks a lot, Toke. And I think quite some people have actually seen it already. So it's good that this is a 20-minute presentation. Big thanks to the Keynes Fund for sponsoring this project. It actually helped me a lot while I was still at Cambridge, as well as now. It made it possible to buy some of the data, made it possible to present in many places before going on the market, which was tremendously helpful. And the Keynes Fund also sponsored a visit for me to UCLA, where I spent a couple of weeks right before going on the market, which was tremendously useful. I met lots of famous American professors there who then knew about the paper. So yeah, it's great to be back, and it's especially great to be back at a Keynes Fund event. So for the minority of you who have not seen this paper yet, I'll go through it. It's a paper on the productivity slowdown. So one interesting fact about the last 30 years is that investments into innovation have increased. The standard measure of that is research and development. If we look at that as a percentage of GDP, that's roughly gone up by 60% over the last 30 years. So we're investing more in innovation and in becoming more productive. But you don't see that in the output of those innovation investments. So we don't see that productivity, which is supposed to follow from investments in R&D, is actually going up. That's what this plot shows, the orange line here. So there was a boom in productivity growth in the 1990s, which was fueled by the rise of information technology. But since then, there's been a slowdown, and growth today, or the last 10 years in the US has averaged around 0.5% per year, which is well below the historic 1.3, 1.5% per year. So somehow these investments aren't paying off. At the same time, we see that there's been a decline in business dynamism. And business dynamism is the process of productive firms entering the economy and growing, and unproductive firms shrinking or eventually exiting the economy. One measure of that is the entry rate. It's the fraction of all firms that's a startup. That's been declining for 30 years. And also the reallocation rate, which is a measure of churn of workers, has also been steadily declining. And finally, there's evidence that corporate market power has been increasing. Market power is a bit more difficult to measure than productivity or business dynamism, but one theoretically pure measure is the markup, the ratio of prices and marginal costs. There's evidence that that's been steadily increasing over the last 30 years. And there's also evidence that product market concentration has been increasing. So there's evidence that a smaller fraction of firms has started to make up a significant portion of production. So the aim of this paper is to link these trends. I'm going to show that there's a very simple and intuitive mechanism that can explain these three trends of productivity growth, business dynamism, and market power jointly. And the claim of the paper is that the joint explanation is the rise of intangible inputs. And with intangible inputs, I mean inputs that are not physically embodied. To give you a particular important example, the rise of software in production. Intangibles have rapidly become more important over time. Software now makes up almost 20% of corporate investments. And today I'll discuss how that might have macroeconomic implications. So I claim that intangibles can explain trends in productivity, business dynamism, and market power because intangible inputs have two features. The first feature is that intangibles create a shift in the cost structure of firms, moving costs away from marginal costs of production and towards fixed cost of production. And the reason for that is that intangibles, like software, can basically be duplicated at zero marginal cost. Once you've invested into a piece of software, whether you deploy that in the production of one product or in N products, basically comes at no additional expense. But you do have to pay for the software. So there's a fixed cost of production and then lower marginal costs. The second feature of intangibles is that firms differ in the efficiency with which they deploy them. And by that, I mean that for the same expenditure on intangibles, some firms are able to achieve a great reduction in their marginal costs than others. There's a whole literature showing that there's these differences between firms. I'm going to be agnostic about the source of the inefficiency, but there is a literature, and if you want to, I can summarize that later on. So the main thing in this paper is that I'm going to add intangibles modeled with those two features, and I'm going to put them in an endogenous growth model with creative destruction. Now, in that model, I'm going to put a subgroup of high intangible firms, so intangible superstars, right? Think of Amazon and the likes. And then I'm going to see in the model what happens with productivity growth, with business dynamism and market power. Now, to give you the mechanism in a nutshell and why intangibles might explain these trends, let's first start with how innovation works in modern models of economic growth. So these models feature growth through creative destruction. They're Schumpeterian growth models. And we usually think of innovation in these models as happening along some sort of quality ladder. So a good is produced at a certain level of quality. And when a competitor innovates, it develops a higher quality version of a particular good. So the incumbent stops producing that good, and there's a new innovator that is now higher on the quality ladder. And over time, through random improvements of the quality of goods, firms change in terms of who produces, who's the market leader in the production of what good, and aggregate quality and therefore aggregate output increases over time. Now, intangibles change that process of innovation on the quality ladder because they introduce a trade-off between quality and price. And that's because even if an innovator is on a higher point of the quality ladder than some incumbent, if the incumbent is one of these high intangible firms, right, so the Amazons of the model, because they're able to produce more efficiently, they can undercut the innovator on price and therefore be the most attractive producer to consumers, even if they're not the highest point on the quality ladder, right? So through that undercutting mechanism, they can prevent that innovator from becoming the next producer and therefore prevent that constant process of standing on shoulders that is the main driver of productivity growth. So I'm going to present a little bit of evidence in line with that idea that I just outlined. There is, though, a whole literature linking some of the macro trends that I mentioned to intangibles, and that literature has basically emerged over the last couple of years, right around the same time that this project was in progress. But so there is evidence, for example, that at the firm level, firms that use a lot of intangibles also have higher markups and have more market power. There's also evidence that intangibles cause increasing returns to scale, so they have that fixed versus marginal cost effect that I just described. And it's also the case that this decline in business dynamism and this rise of market power is particularly present in high intangible sectors. So industries where there is actually a room for intangible inputs to drive the trends that I described. There's also new evidence in the paper, and this was partly made possible through the Keynes Fund. I rely on microdata on France and the United States. For France, I've got data on the universe of firms for 20 years from tax records. For the US, I have data on publicly listed firms, which I can now match to firm level IT data as well from Hardy Hanks. And what I do in the paper is I measure fixed cost with a new measure using the difference between markups and profits. Now, if you're willing to assume that a firm's marginal costs are constant within a firm year, you can actually back out what a firm's fixed costs are by comparing the markup, which again is the ratio of prices to marginal costs, which is the firm's marginal profit of producing its good, with the firm's average profits, which is just a ratio of its profits and its revenue. And because the profit rate, the ratio of profits over revenue, gives a measure of average profits from the difference between marginal profit and average profit, you can back out what a firm's fixed costs are. And then you can see whether firms with more fixed costs have higher markups, have more investments in software, etc., like the model predicts. So what you see over time is if you measure fixed costs through that, so through the difference between markups, marginal profits, and average profits, you see that fixed cost increase over time. You see that in the French data set, in the American data set, and that's basically happening across industries. So it is true that the IT industry on average has higher fixed costs than, for example, manufacturing. But in all industries, if you compare recent years with all the years, there's been an increase in the use of fixed costs, right? So the upward trend in intangibles that we're seeing, the upward trend in fixed costs is happening within industries, and it's not just driven by a rise in the use of in just a rise of IT sectors. It's happening everywhere. You can even look at this at the firm levels. You can look at the kind of IT systems that firms have installed and see whether a firm's fixed cost over total costs are higher if the firm has a particular technology installed, right? So you can measure, for example, whether a firm that has enterprise resource planning installed has higher fixed costs than other firms, and that turns out to be the case, and the effect is large, right? So on average, this fixed cost ratio is something like 15% for French firms, and you see that if a firm has ERP, right, an important software system, but just one, that increases that ratio by 1.5 percentage points, right? So that on a base of 15, that's very large. What I also show in the paper is that firms with higher fixed costs invest more in innovation, grow faster, and charge higher markups, exactly in line with the mechanism that I started with. So the main part of the project is that I then put those intangibles into a model of Schumpeterian growth, of growth through creative destruction, where firms expand the range of products that they can produce through research and development. Right? And what I introduce in the model is these high IT, high intangible firms that have lower costs of production and can therefore trade off for consumers, either buying from the most innovative, latest producer, latest innovator, or from a high intangible firm that is able to produce more cheaply. Now, because these high intangible firms undercut consumers on price, firms that are not intangible superstars, right? So firms that are not Microsoft or Amazon are not going to try to enter new markets. And that's because they know that if they do try to enter a new market, they're going to face Amazon, and it's going to undercut them on price and therefore prevent them from innovating. So what the model then predicts is that there's going to be some firms that invest a lot in innovation, because Amazon in this model wants to basically produce any good out there, right? It's going to start a supermarket, run an airline, start producing cars, and other firms are not going to try and innovate at all. Right? So the model predicts that if everyone was good at IT, if everyone was equally investing in intangibles, there'd be an increase in innovation from the rise of intangibles in the data. But if there's inequality in the use of intangibles, if some firms are using more intangibles than others, because it allows these high intangible firms to undercut competitors on price, there's going to be polarization where some firms invest a lot and some firms invest a little. Now, we know from the data that the marginal product of innovative investments, of research and development, are concave. So if you have some firms investing a lot and other firms investing very little, the average rate of return to research and development declines. And therefore, the model predicts that as you get these high intangible firms entering the economy, there's going to be a lower average rate of return to R&D. And so even if total research and development increases, there's going to be lower aggregate growth, exactly like we see in the data, right? So more investments into growth, but less aggregate growth. Now, I'm almost out of time, so I'll just go over the headline results. I won't do them step by step, but I calibrate the model to match the United States economy in the 1980s. And then I infuse the economy with a group of high intangible firms that slowly start dominating the economy. And if you then compare the steady state, so the end point and the starting point, there's going to be a 0.4 percentage points lower growth rate of productivity, despite a large increase in R&D. There's going to be less entry and there's going to be higher market power. And so what this table shows you is that these numbers line up reasonably well, even though only entry and the increase in intangibles is targeted. So it seems that this model is able to quantitatively explain some of the macro trends that we see in the data. What the model is also able to do is to explain the path of productivity growth over time. Because as I said at the start, it's not the case that productivity growth has been falling monotonously for the last 30 years. Initially, productivity growth was booming. That's something that this model predicts, because as high intangible firms enter the market, right, as Amazon starts producing and starts dominating the economy, there's initially a booming growth, because anything that these firms produce, they produce at lower costs than their competitors, right? So there's an initial booming growth, but as they start becoming dominant, that lost innovation channel where lots of firms are unable to enter the market and the innovation is misallocated towards a couple of very high innovation firms, that's when there's slowly a reduction in the productivity growth rate after a boom that lasts about 6 years, which if we compare it to the data is roughly the experience of the US in the year 2000, even though there's nothing in the model that pins that down to 6 years, to 100 years or 1,000 years. It just turns out that innovation roughly takes as long in the model as it does in the data. So with that, I'm out of time. So just to summarize, the aim of this paper is to explain three trends: slow productivity growth despite high R&D, a fall in business dynamism, and a rise of market power. And I explain that through the rise of intangibles that reduce marginal costs and raise fixed costs, and that some firms are better at than others. Right, so the big lesson here is that there's a market failure if some firms are able to use intangibles more efficiently than others, and that's because they're able to undercut competitors in price. Right, so if you want to benefit from this whole rise in software and intangibles at a macro level, that only happens if the rise of intangibles is inclusive, if a sufficient fraction of firms has access to this. So the paper is currently R&R. I'm hoping to resubmit it over in 3 weeks. So any comments that you guys have are welcome. And thanks again to the Keynes Fund for helping to make this possible.